Services. Capital gains and losses is our topic. This, of course, Tom Hirsch from Jackson Hewitt Tax Services to tell us more about why you can come from and affects your taxes if you did very well or if you lost some money.
Well, it can affect your taxes in most cases. First of all, capital gain is sale of any capital asset. You most often think about is stocks and bonds. But of course, as you mentioned, it could be investment property, real estate, or your 1911 Swagger baseball card. So any asset you cash in and sell at a profit can result in a capital gain.
Some people would think that a capital loss is that a loss is bad news, but not necessarily with your taxes, because sometimes you can claim those losses. You can deduct that. Do they become a deduction in some scenarios?
Yes, a capital gain or a capital loss is subtracted from your income, and of course it will offset any capital gain you have first.
Okay.
And then in addition, once all your capital gains are offset, if you still have additional capital losses, you can write off $3,000 a year against regular income and reduce your income by that level. Any excess over that $3,000 is carried forward to future years, where you can take $3,000. First, it'll be offset against capital gains, and then it'll be offset against regular income up to $3,000, and the remainder carried forward yet again.
Okay. Whenever we talk about things like this that can affect your taxes, especially things that you're trying to claim as deductions, that documentation has to be there. So what kinds of receipts or, I guess, evidence should you be prepared to provide the IRS? That's
the big concern we have with capital gains every year, particularly with stocks and more with mutual funds, because most people have mutual funds and they keep reinvesting and reinvesting and reinvesting over and over again. And they could have started back in 1970 or 1980, and once we sell the asset, your capital gain is computed on your sales price minus expenses against your basis, which is what you bought the original asset for. And if you bought it way long ago, some people don't keep the records, especially mutual funds that keep accumulating, and it's very difficult for us to do the basis. Now, starting in 2011, the IRS, as a byproduct of new IRS regulations, the companies must maintain the basis and report it to you. But that's only for assets that are bought after 2011. Anything before that, you're still on the hook to do your own computations and keep your own documentation.
All right. That can be tricky. People are busy. These are the kinds of things that you fall through the cracks.
And that's one of our most difficult things every year, is for people that bring in sales, and then we say, okay, show us your basis, and it's, I don't know if I still have that.
Yeah.
And in the worst case, without documentation, it has to be zero basis, and you have to pay a gain on the full sales price, which is really unfortunate because most of these were acquired and cost you money originally.
All right.
And that's sad.
So hold on to those receipts. Maybe go back to thehamptonroadshow.com, find Amy Vogel's last segment on organizing all your tax information, and get started so you always have the documents you need, especially when dealing with something like capital gains and losses. If you have more questions for Jackson Hewitt Tax Service, you can find them online at jacksonhewitt.com or call 1-800-234-1040. And Tom is actually going to stick around to answer some of your viewer questions, so look for him coming up in a moment in The Buzz. Thanks, Tom.